Cryptocurrency is digital money that uses encryption techniques to secure transactions and control the creation of new units. Bitcoin, which launched in 2009, was the first widely adopted cryptocurrency. Bitcoin and most other cryptocurrencies are decentralized, meaning they are not issued or regulated by any central authority like a government or bank. Instead, cryptocurrencies use blockchain technology to record transactions on a distributed public ledger called a blockchain that is maintained by a peer-to-peer network. The ledger is distributed, meaning it is replicated and shared among all nodes in the network. Decentralized consensus mechanisms like proof of work or proof of stake are used to verify transactions and add new blocks to the blockchain. Blockchain technology provides transparency, security, and immutability, as records cannot be altered retroactively without altering all subsequent records and getting consensus from the network. Today, there are over 20,000 different cryptocurrencies in existence, with a total market capitalization of over $1 trillion. While Bitcoin was the first, and is still the most well-known cryptocurrency, others like Ethereum, Cardano, Solana, and Dogecoin have gained traction. The adoption and popularity of cryptocurrencies has grown exponentially in recent years for purposes like trading, investment, decentralized finance, and alternative payment systems. However, they continue to be highly volatile assets and carry risks for investors. Ways to make money with cryptothere are several ways to potentially profit from cryptocurrencies. In the most basic way is to simply buy cryptocurrencies like Bitcoin or Ethereum and hold them long term. The goal is for the coins to increase in value over time so they can eventually be sold at a profit. This requires researching cryptocurrencies with solid technology and adoption potential. Trading, for more active investors, trading cryptocurrencies can potentially yield returns. This involves buying low and selling high by closely monitoring price movements and news. Day trading, swing trading, and scalping are common strategies. Technical analysis of charts is often used to identify trading opportunities. Lending and staking lending platforms allow you to earn interest by lending your crypto holdings. Staking involves holding funds to help operate a proof-of-stake blockchain network, which is rewarded through staking rewards. Both allow earning passive income on cryptocurrency investments. Mining cryptocurrencies involves using computer hardware to solve complex math problems that validate transactions on a blockchain. Miners are rewarded with newly created coins. However, mining requires technical expertise and access to low electricity costs to be profitable today. Airdrops. Some blockchain projects airdrop free tokens or coins to wallets that hold or interact with their platform. Holding certain cryptocurrencies may make you eligible to receive airdrops, allowing you to gain free crypto. Jobs. There are also opportunities to earn an income working for cryptocurrency companies, such as exchanges, wallet services, platforms, and other blockchain startups. Roles may include developers, marketers, designers, customer support, and management positions. Investing in cryptocurrencies involves buying digital assets like Bitcoin, Ethereum, or other altcoins, with the aim of generating long-term returns as the value appreciates over time. This strategy relies on the principle of buying low and selling high. Long-term holding. One of the most common investment strategies is to simply buy major cryptocurrencies like Bitcoin and Ethereum and hold them long-term. Historically, Bitcoin has experienced significant price appreciation over 5-plus-year timeframes. Although volatile in the short term, long-term holders believe the value will continue to increase as adoption grows. A benefit of long-term holding is avoiding the stress of day trading and being able to essentially set it and forget it. However, cryptocurrency prices can fluctuate wildly in the short term, requiring mental discipline. Dollar cost averaging is one way to smooth out volatility. Dollar cost averaging means buying a fixed dollar amount on regular time intervals, like $100 per week. This reduces risk associated with investing a large lump sum right before a market crash. Dollar cost averaging ensures you buy fewer coins when prices are high and more when prices drop. Over time, this can lower your average cost per coin. Managing risks. Cryptocurrencies tend to be highly volatile. To manage risk, only invest an amount you can comfortably afford to lose. Many experts suggest dedicating no more than 5% of your portfolio to crypto. It's also important to have a diversified portfolio by investing in various assets like stocks, bonds, real estate, etc., not just crypto. Taking profits. Timing when to sell and take profits is challenging. Novice investors tend to sell too early if prices drop slightly, locking in a loss. Savvy investors wait for assets to at least X for X before selling a portion of the investment while letting the remaining coins continue to appreciate. Taxes also need to be factored in when profiting from crypto investments. Trading cryptocurrencies. Trading cryptocurrencies involves buying and selling digital assets for profit. Unlike investing, trading aims to capitalize on short-term price movements in the crypto market. Here are some key aspects of crypto trading. Technical analysis. Analyzing price charts and market indicators to identify trading opportunities. Common techniques include trend analysis, support or resistance levels, candlestick patterns, volume momentum oscillators like RSI, and moving averages. Platforms like TradingView allow traders to conduct advanced technical analysis. Trading strategies. Applying rules and methods to open and close trades profitably. Popular strategies include day trading, swing trading, scalping, arbitrage, and algorithmic trading. Traders may automate strategies via bots. Backtesting strategies on historical data determines their viability. Risk management. Managing risk is crucial for trading success. Key principles include setting stop losses on each trade, limiting position size or leverage, diversifying across assets, and maintaining portfolio hedges. Most traders risk 1-5 of capital per trade. Trading tools and in platforms. Cryptocurrency exchanges like Binance, FTX, and Coinbase Pro enable trading major coins and tokens. Advanced platforms exist for margin trading, derivatives, automation, charting, portfolio management, and more. Hardware wallets securely store assets. With the right strategies, tools, and risk management, crypto trading can be highly profitable. However, it requires knowledge, discipline, and tolerance for volatility. New traders should educate themselves, start small, and develop their skills over time, but the rewards can be immense for those who master crypto trading. Lending and staking. Cryptocurrencies. How lending and staking works. Cryptocurrency lending and staking are ways to earn passive income on your crypto holdings. With lending, you deposit your coins with the lending platform that then lends them out to borrowers and pays you interest. When staking, you deposit coins into a staking pool to help validate transactions on proof-of-stake blockchains and earn staking rewards. Both allow you to earn returns without having to actively trade or sell your coins. The platforms and protocols handle matching borrowers and lenders or validators and stakers behind the scenes. With lending, interest rates can vary greatly depending on supply and demand. Staking rewards are usually a fixed percentage, but can fluctuate some. Overall, PYs for lending and staking top cryptocurrencies are around 3-12. Risks and rewards. Lending and staking carry some risks of capital loss, though the risks are generally lower than active trading. With lending, borrowers may default and be unable to pay back loans. Platforms try to manage this using over-collateralized loans, but losses can still occur. Staking has slashing risks if validators misbehave, as well as risk of your staked assets losing value. There's also the risk of your staked assets being locked up for a period of time. However, lending and staking remain relatively low-risk ways to earn attractive yields on crypto. The rewards generally outweigh the risks for long-term investors willing to handle some volatility. Best platforms for lending. Top platforms include Compound, Aave, Celsius Network, Nexo, and BlockFi. They offer reasonable rates with collateralization and insurance to limit defaults. for staking, leading options are native wallets like Daedalus and Yorwa for Cardano, Polkadot for Polkadot, as well as exchanges like Kraken and Binance. Staking on trusted, established platforms helps ensure reliable rewards. When choosing a lending or staking platform, consider factors like transparency, security, rates offered, risks involved, and ease of use. Spreading assets across multiple platforms can help diversify and minimize risks as well. Mining cryptocurrencies. Cryptocurrency mining is the process of verifying blockchain transactions and adding those transactions to the public ledger or blockchain. Miners compete to solve complex math problems in order to verify a block of transactions. The first miner to solve the math problem adds the verified block of transactions to the blockchain and receives a reward in cryptocurrency. To participate in crypto mining, you'll need mining hardware. Specialized hardware designed for mining cryptocurrencies like ASIC miners or GPU rigs. More computing power equals greater chances of winning a block reward. Mining software to connect your mining hardware to the blockchain network. Examples include KegMiner, VMiner, EasyMiner. Wallet. A crypto wallet to store any coins earned from mining. Hardware wallets or paper wallets are preferred for security. Membership in a mining pool. Joining a mining pool allows you to combine computing power with other miners and share block rewards. Solo mining is difficult with increased blockchain mining difficulty. The profitability of crypto mining depends on factors like cost of mining hardware and electricity, your hash rate, the processing power of your mining rig, network difficulty, and competition from other miners. Value of the cryptocurrency being mined. Any pool fees. If you join a mining pool when the cost of mining exceeds the value of the block reward and transaction fees, mining becomes unprofitable. You can use a mining profitability calculator to determine potential mining revenues based on current mining parameters. Overall, crypto mining can be profitable, but requires significant upfront investment in equipment and optimizing mining operations. It's best suited for those with ready access to low electricity costs. Earning from airdrops. One way to potentially earn crypto without investing any money is through airdrops. An airdrop is when a cryptocurrency project gives away free coins or tokens to the crypto community to raise awareness and drive adoption of their project. To participate in airdrops, you'll need an existing cryptocurrency wallet that is compatible with the airdrop's requirements. For example, some airdrops may require you to hold a certain cryptocurrency or token in your wallet to qualify. Other airdrops may simply require you to perform some tasks like joining their Telegram group or following them on Twitter to be eligible. There are a few ways to find out about upcoming airdrops. Airdrop announcement sites like Airdrop Alert and Airdrops Mode. These sites list active and upcoming airdrops along with instructions on how to qualify. Cryptocurrency forums like Bitcoin Talk and Reddit. New projects often announce their airdrops on crypto forums. Social media. Follow crypto projects and influencers on Twitter and YouTube to hear about airdrops. Email newsletters from cryptocurrency services. Airdrop apps like CoinMarketCap's drop page, which alerts you to airdrops on your wishlist. The amounts distributed via airdrops can range from a few dollars to hundreds or even thousands of dollars worth of crypto. However, there is no guarantee you will receive the airdropped assets or that they will hold their value over time. It's best to view airdrops as an added bonus rather than a reliable source of income. One important thing to note is that airdropped coins may be subject to income tax depending on your jurisdiction. You may need to pay taxes if you later sell the airdropped crypto for fiat currency. Consult a tax professional to understand any potential tax obligations from participating in airdrops. Cryptocurrency jobs. There are various ways to find work in the cryptocurrency industry today. Some of the most common job types include software development. With the rise of blockchain technology, there is huge demand for programmers familiar with languages like Solidity and Rust to build decentralized applications. Programming skills, knowledge of cryptography, and experience with cryptocurrency protocols are in high demand. Companies are actively hiring developers to work on cryptocurrency and blockchain projects. Marketing and communications. Cryptocurrency companies, large and small, need marketing experts to help promote and communicate their products and services. Skills in areas like digital marketing, copywriting, community management, and PR are valued. Knowledge of the industry and active involvement in the crypto community is a big plus. Analyst and research roles. As the industry matures, there are more opportunities for analysts and researchers at crypto exchanges, hedge funds, VCs, and blockchain startups. Those with financial modeling skills, analytics capabilities, and a deep understanding of blockchain technology trends are well suited for these roles. Operations and compliance. To serve customers and remain legally compliant, crypto companies need operations and legal experts familiar with cryptocurrency and regulations. There are opportunities in fraud investigation, compliance management, customer operations, and related fields. Engineering and academic positions. For those with very technical skills, there are engineering and academic roles emerging as well. Building the core infrastructure and pushing theoretical knowledge in the industry forward. The most promising way to find cryptocurrency job opportunities is to search listings on crypto or blockchain-specific job boards like CryptoJobs List, Crypto.jobs, Cryptocurrency Jobs, etc. Mainstream sites like LinkedIn, AngelList, and Remotiok also routinely have relevant job postings. Being active in crypto or blockchain communities also helps uncover opportunities. Tax implications. Profits or losses need to be reported on your taxes. Just like any other investment, here's what you need to know about the tax treatment of crypto. Cryptocurrencies are treated as property by the IRS, not as currencies. This means they are subject to capital gains taxes. You owe taxes on any crypto profits you realize when selling, trading, or spending your crypto. For example, if you bought one BTC at $10,000 and later sold it for $15,000, you would owe capital gains taxes on the $5,000 profit. Losses can be deducted to offset capital gains, or up to $3,000 of ordinary income. So if you lost $5,000 trading crypto, you could deduct $3,000 from your regular income for that tax year, and carry the remaining $2,000 forward to future years. Buying goods and services with crypto is a taxable event. If the crypto has increased in value since you bought it, you will owe capital gains tax based on the difference between the original purchase price and the value at the time of the transaction. Cryptocurrency you earn from mining, staking rewards, airdrops, or as payment for services is counted as taxable income. The value of the crypto at the time you received it sets your cost basis for future capital gains. Detailed records of all crypto transactions must be kept with dates, cost basis, fair market value, and transaction fees. Most exchanges provide account transaction history to help with this. In the US, crypto taxes are due each year by April 15th. No matter how much you owe, if you don't accurately report crypto transactions, you could face interest and penalties from the IRS. Proper reporting of crypto taxes can be complicated. Working with a qualified crypto tax preparation service can help you stay compliant and optimize tax savings. With some planning, you can manage crypto taxes while continuing to capitalize on this emerging asset class. Getting started making money with cryptocurrencies like Bitcoin and Ethereum present new and exciting opportunities to generate income. However, it's important to educate yourself and be aware of risks before jumping in. Here are some tips for beginners. Do your research before investing any money. Learn the basics of how cryptocurrencies work and the fundamentals that drive market value. Understand the difference between major coins like Bitcoin vs. altcoins. Research exchanges, wallets, DeFi platforms, and other ecosystem participants. Start small and invest more than you can afford to lose. Consider starting with small amounts and building your portfolio over time. Set aside an amount you feel comfortable experimenting with. Choose secure storage. Select a secure crypto wallet and keep private keys safe. Never share them. Hardware wallets like Ledger and Trezor provide offline storage. Also, beware of scams. Don't ever enter your private key on a random website. Dollar cost average rather than buying all at once. Dollar cost average by making periodic investments. This helps manage volatility and reduce risk from poor timing. Stay up to date. Keep learning about crypto trends, news, and new projects. Follow official announcements from coin teams. Stay up to date on regulations and tax rules. Don't overtrade. Constantly trade and chase quick profits. This rarely works long term and leads to unnecessary fees. Have a long-term investing strategy instead. Watch for scams. There are many scams in crypto: fake coins, Ponzi schemes, phishing sites, and more. Don't invest in anything without vetting it thoroughly first. If something seems too good to be true, it probably is. Consider taxes. Depending on where you live, you may need to pay taxes on crypto trading, conversions, DeFi rewards, ENFT sales, and other income-generating activities. Keep good records. Manage risks. While crypto offers big upside, it also comes with significant risk. Prices can swing wildly. Understand these risks and invest wisely. Don't put in more than you can afford to lose. With the proper education and precautions, cryptocurrencies present a pathway to generate wealth. Do your homework, start small, and be wary of scams. With some prudent planning, you can position yourself to profit from this new financial frontier. 1. The Beginner's Guide to Making Money with Crypto. 2. 3 Simple Ways to Turn Your Crypto into Cash. 3. How to Earn Passive Income from Cryptocurrency. Invest and learn strategies to profit from crypto like trading, mining, staking, yield farming in 2023. Key tips to maximize crypto earnings from Bitcoin and altcoins.